If you treat people right at even what is a difficult time, those relationships will last and they'll have meaning and impact down the road. I'm a big believer that company culture is defined by the first 20 employees at the company. And I'm also a big believer that culture is really hard to change. There's no better feeling than building something that touches millions of people.
Welcome to Trailblazers, the podcast where we sit down with contrarian tech leaders who found conventional success in unconventional ways. Today on the show, I am so excited to be joined by Satya Patel. Satya is the co-founding general partner of Homebrew, a seed-stage venture capital firm based in San Francisco. Through Homebrew, Satya has backed some of the most impactful startups of the past decade, including Chime, Cruise, Phoenix, Gusto, Habi, Honor, Plaid, Shield AI, and many more. He's also the co-founder of ScreenDoor, an investment platform designed to support emerging fund managers by pairing mentorship from experienced GPs with anchor capital from world-class institutional LPs. Before becoming a venture capitalist, Satya served as VP of product at Twitter, where he built and led the product management and user services teams during a pivotal period of the company's growth. I just realized I should probably call it X, so we'll say VP of product at Twitter/X. Prior to that, he held venture and product roles across the tech ecosystem, including serving as a partner at Battery Ventures and as a product management leader at Google. Satya has been recognized on the Forbes Midas list for his track record backing category-defining companies, particularly in fintech and AI. The U.S.-born son of Indian immigrants, he grew up in Las Vegas before building a career at the intersection of technology, product, and venture capital. Let's welcome Satya.
That's such a nice intro. Thank you.
Of course. Well, you've done some good things. It's not that hard to write it up.
Better to be lucky than good.
I love it. Okay, so before we get into the meat of the interview, I like to start with an icebreaker.
Mm-hmm.
Okay, so I like to say traditional interview wisdom is that you should start with a softball, but we like to do the opposite, in true contrarian venture fashion.
Dive right in.
Dive right in. So I'd love to ask you, whatever comes to mind, please share.
Mm-hmm.
What has been the hardest part of your journey so far? When you hear that bio back, whether it's personal or professional, what stands out to you as like the moment that almost broke you? That was very difficult.
I think there's so many times in someone's career where they feel like things are broken, and getting past those moments is a real challenge, and it doesn't happen on your own. So I've been really fortunate to have wonderful peers and mentors who have really made a difference in my career. And there's two moments that I can think of that were really difficult. One was actually near my end of my time at Google. I had been the lead product person on a product we were building internally called AdSense for Publishers, which was basically an ad-serving platform that we were going to make available to everyone in the Google ecosystem. And really near the launch of that product, we decided as an organization to acquire DoubleClick. Mm-hmm. And I had worked at DoubleClick prior. And
really?
Yes.
I didn't know that.
Yeah, so I worked at DoubleClick, but joined Google in 2003, and then we ended up buying DoubleClick in 2007.
Did the suggestion come from you, or was it totally random?
I helped to work on the
orchestrate
acquisition.
that, yeah.
But the unfortunate part of that is we knew that the FTC was going to look into the acquisition, and so we basically had to pause the launch of what I had been working on internally because it was in the same space as what DoubleClick was doing. So that was a really difficult time because me and my team had spent a year and a half building this product, testing this product, putting it in the hands of beta publishers, getting it ready for a broad launch, and all of a sudden we had to freeze everything. And it was really challenging because it wasn't just disappointing because of the effort that had been put in, but it was because at Google at the time, you convinced people to work on projects with you, and I had brought all these people along with me. So it was more I was disappointed for them than I was for myself, and I felt like I'd really let all of them down. And then we all had to go basically figure out like what else we were going to work on within Google at that time. And so it became my priority to try to help everyone kind of figure out where to go within Google.
How many people was there on your team?
On that
you had
team,
to help?
It was like product people, engineering people. It was always a cross-functional effort.
Yeah.
But there were probably, call it 25 people working on it.
Yeah.
And that was a really challenging moment for me because, as I said, I felt like I'd let everybody down. And then I had to figure out what to do myself. And that eventually actually led me to leaving Google and joining Battery Ventures. But I had an incredible peer mentor at Google at the time, a guy named Gokul Rajaram, who's
I know Gokul very well. Yeah, Gokul knows everyone.
Godfather of AdSense.
Yeah.
He and I are still very close. I think helped him do his first angel investment ever and turned him into an investor.
Which company was it?
It was called World Golf Tour.
Whoa, sounds like a cool one.
Yeah, it was a cool one. It was basically one of the first companies to leverage drone technology, and in its case was mapping golf courses and turning that into an online game. I think Topgolf ended up acquiring it, if I remember right. But anyway, it was the start of Gokul's angel career. But he was instrumental in helping me figure out kind of a path forward.
And he was at Google at the time.
He was at Google at the time. He was working on AdSense as well.
Yeah. Isn't it wild how small the world is? That like 2 plus decades later, you and Gokul still jam and are kind of doing the same thing-ish?
I mean, my partner in Homebrew, Hunter, and I sat this far from each other at Google too. So at that time, the best thing that came out of Google was the people that we worked with and the network that we have even today, right? People that we've invested in, people that we co-invest with, people that we leverage their expertise from. That network of people from that era at Google is really special.
You know what's interesting? I actually, now that we're talking about it, that era of Google was special, but so was the era when you were at Twitter.
Yes.
Like, I've talked to so many people that were at Twitter that exact same time. Yeah. And maybe part of it is because they were at Twitter, they have like a good following on Twitter. And so then it all feeds into itself that they now get big opportunities because they were part of the early Twitter mafia. But I feel like you were actually part of those two different cohorts.
Yeah. Twitter had equally exceptional people, but probably the exact opposite culture. Mm-hmm. And it just goes to show you the impact of culture on company building, which is certainly one of the big lessons that we think about and employ doing our investing at Homebrew.
Yeah.
But the people at Twitter were stellar. But that leads to the second kind of harrowing moment in my career, which was running product at Twitter, having pretty fundamental disagreements around the product and the direction of the product. And then similar to kind of that frozen moment at Google, getting to the point where we were thinking about the IPO and it being very clear that things were going to stop from a product development standpoint. And the vision that we had laid out was going to be put on pause in order to kind of not break things prior to the IPO. And it was just a very difficult time to be part of senior management there for a bunch of reasons. And so, again, like had to make a really difficult decision to leave an organization where the people were stellar. It was a product that I really cared about, and an organization and team that I'd helped build, and feeling like I had protected the team from a lot of what had been going on. At the company level and at the management team level, but I wasn't going to be in a position to protect them anymore, and had to make the decision to leave, not knowing what I was going to do. And as things go, that led to the creation of Homebrew and me working with Hunter again. And so, all good things come from deep despair, I guess.
Yeah.
But it was a really challenging time at that moment too.
Sounds like it. What's your advice for someone? Let's say they're in that situation now where maybe there is some big M&A coming down the pipe, some IPO coming down, or there's just management struggles and they feel stuck. Maybe they can't protect their people. A lot of the things you mentioned. What's your advice for someone for when to leave versus when to stay?
Yeah, I think the first thing I'll say, which is really a difficult lesson, is that no one's going to look out for you but yourself. So you have to do what's right for yourself at the end of the day. But at the same time, you don't want to damage organizations or people on your way out. And so doing as much work as possible to help the organization and people land softly will serve you well in your career very long term, because at the end of the day, as we talked about, everywhere you work, it's really about the people, the organization, the culture, and that's going to carry forward in your career. So if you treat people right at even what is a difficult time, those relationships will last and they'll have meaning and impact down the road. There are even people who, when I joined Twitter, we had to make the decision to lay off some of the product organization. And at the moment, that was really challenging for those people. But in retrospect, they look at it as the right decision we made and the right decision for them. And those people are really strong relationships for me even now. Even though at the moment there were really challenging positions that those people were put in.
Yeah, I think that's such a testament that like you either had to let them go or they left your team and you still have that closeness.
Yeah.
How you said, the cultures are so different at Google and Twitter, but both stellar.
Yeah.
If you had to sum it up in one adjective for people who weren't there, Because I think what Google's like now, what Twitter's like now, it's so different than when
Yeah.
you were there.
Yeah.
1 decade ago, or I guess 15 years ago for Twitter and 20 plus years ago for Google. Like, how would you sum it up if you had to articulate?
I think everything in culture, whether it's Google or Twitter or otherwise, comes down to trust. And Google was a culture of trust. People assumed that you were doing the best thing for the company, and it was a culture of yes. Like, yes, you can do that. Yes, you should try that. Yes, you should go work with that person. And Twitter was a culture of distrust. Everybody looked at it, or the organization created a culture in which people felt that their job was to say no. And it really got in the way of the people and the company being as special as they could have been. Still very impactful, and I think the view of the people who worked there at that time is that Twitter should be more important on a global scale than it is today, certainly within the confines of, I guess, SpaceX now. And it's a great disappointment that for those of us who were there, like, we couldn't impact the culture in the way that we wanted to, especially since so many of us had come from Google and seen what the value of culture had meant for that organization.
Yeah, that's so fascinating. But it sounds like you look back fondly on both cultures, even though they had different experiences. Or do you feel like the Twitter culture was just a lot more brutal?
I look
the
back
Google culture?
fondly on both experiences.
Yeah.
And I look back fondly on the group of people that I had the opportunity to work with.
Yeah.
I wouldn't say I look back fondly on both cultures.
Yeah, that's fair. So what's interesting is, you had, let's call it like operating venture stints. You sort of went back and forth. And the two hardest moments were your operating stints.
Yeah.
They were not your venture stints.
Yeah.
There's a lot of conversation online, and maybe it's just very clickbaity to say, like, operating is so much harder, founding is so much harder, product market fit is so much harder than venture and investing, and you don't really go through hard times as an investor. That's like the general sentiment, which, like, okay, I agree. I think product market fit's like the hardest thing ever. What's your take on, like, what is harder? Can you compare them as someone who's done, both twice and been around for a while and seen a lot? What's your take on what's harder?
They're both hard in different ways, no question. And honestly, I don't think that most people are cut out to do both well because they are so different, right? On the operating side, you work in cross-functional teams. You work in organizations that are generally growing quickly. If you're at a successful organization, you're constantly establishing and reestablishing product market fit. You have metrics that you're held accountable to on a daily basis. And you have the existential threat of kind of going out of business at any moment. So those pressures and those dynamics lead to a very different set of challenges. The venture business is completely different because there's no daily scorecard. You're generally not working in massive teams. There's no feedback cycle, right, except in a 10 to 12-year time frame. You don't actually own and control anything, right? You exercise influence if you're lucky, but most of what we do is non-deterministic. And so that introduces its own challenges. And I think there is a psychology of venture which is really difficult, which is you have to believe you're kind of smarter than everybody else. But the data that you get in the short term, and oftentimes what the market tells you, is that you're wrong. And to have the courage of your convictions in that way is really challenging psychologically. That's why I don't envy folks like you who do this on a solo basis. Like, I don't think I could. Like, Homebrew wouldn't exist if it wasn't for my partnership with Hunter, because I don't think either of us would have the stomach to do this on our own. But that's a different set of challenges than the challenges on the operating side. Both have their own challenges, and I'd say the meaning in the jobs is a little bit different too. There's no better feeling than building something that touches millions of people. Like, I will never replace that feeling through anything I do in venture. But part of the reason we wanted to do what we did with Homebrew is because when you become senior management, your job is to help other people be successful and have that feeling. And as venture capitalists, we get to kind of do that over and over and over again, if we're lucky. And so we were just at a point in our careers where we were okay getting a different kind of satisfaction.
Yeah. You get the dopamine hit from seeing someone else experience it versus needing it yourself.
Exactly.
Yeah.
Though we still need it ourselves on occasion.
Yeah, I know. You still got to find a way.
Yeah.
Like, that's why you see a lot of VCs incubating things. They need that hit, you know? So I'd love to talk a little bit about starting Homebrew.
Mm-hmm.
So like you mentioned, you had left Twitter and you'd had that battery experience.
Mm-hmm.
So you knew about venture. What made you want to start Homebrew? What made you want to start Homebrew with Hunter? And then we'll kind of go from there.
Yeah. Actually, Hunter and I had become kind of good friends. We'd angel invested together, advised together. He was running product at YouTube, and I was running product at Twitter. So we were kind of trading notes, several times a month, and getting together about once a month. And so during one of our normal breakfasts, we realized that each of us was thinking about leaving our respective jobs. And because we had tried to do so many things together, I had, in fact, tried to get him to come work with me at Twitter. We knew that we had maybe a unique opportunity to work together again, as we were both thinking about leaving our respective jobs. And if we didn't take advantage of that moment, it probably wouldn't exist again because we'd be tied up doing whatever else we were going to do. And so we decided that we were going to work together again without having any clue what it was we were going to do. And so then...
Like, it could have been a business. It could have been a startup.
In fact, that's the original thought was to start a business.
Wow.
But Hunter made it pretty clear that one of the things he wanted to avoid going forward was being a manager. He never wanted to manage anyone ever again. So that kind of ruled out starting a company.
Yeah, I was going to say, that's a small company.
But we evaluated all kinds of different things. And ultimately, the second decision beyond the first of working together was we want to focus on certain themes and certain types of work. And so we viewed AdSense and Google and Twitter as kind of these technology platforms that had helped level the playing field between the head of the tail and the long tail. And we wanted to bet on this notion that technology would continue to be a democratizer. As it was getting cheaper, more flexible, more accessible, it would really impact individuals, small businesses, and even enterprises and industries that historically hadn't leveraged technology. And we thought that was a 100-year bet worth making.
And just so everyone knows, too, this was 2013, 2012?
This was 2012.
Right.
We were talking about
so
this.
now it's like, oh, yeah, of course, that's what the Internet's for. But, this was more novel back then.
Yeah.
Important to place people in time, too.
Yeah, I wouldn't say we were, particularly insightful, but we knew what we cared about.
Yeah.
The second thing that we knew is we wanted to spend our time at the earliest stages of company building. We had gotten to be senior managers and leaders at companies, and we knew that took us away from the work that we loved doing, which was really around product and around building organizations at the early stages. And so we wanted to spend all of our time there as much as possible. And then we thought we had something to offer to the ecosystem given our experience, particularly to founders. And at that time, if you remember the 2012 timeframe, there weren't actually a lot of seed funds. There was the first generation of seed managers like First Round Capital and Floodgate and Harrison Metal and Uncork. But then there had been a lull as we worked through the global financial crisis. There weren't a lot of new seed funds. So most cap tables that even he and I were a part of were filled with individual checks or angel investors or maybe small seed funds. And it surprised us how often we were getting the first call when there was a problem that the founders were facing. And so we said, well, there seems to be kind of white space in the venture market that would allow us to spend all of our time working with companies at the early stages and betting on this technology belief that we had. And so venture capital turned out to be the business model that allowed us to do the work that we wanted to do.
I mean, it could have been like a consulting agency. I mean, it could have been like a bunch of different things. But venture was the model.
Yeah, we thought about an accelerator. We thought about consulting. People wanted to acqui-hire us as a team to work on either within a company or even at some of the larger venture platforms.
Yeah.
But ultimately, we decided that we would start our own to have as much agency and control over executing the business in the way we wanted to execute it, which meant that we probably weren't going to optimize for the economics of the business as long as we could do it well enough to justify the cost of doing the work that we were doing.
Yeah. You've been, I mean, we'll get into this a little bit later, but you've always been pretty contrarian with the economics of venture, whether it's with Screen Door, whether it's now with Homebrew, we'll get into all of that. But you've always been very thoughtful and contrarian, that's the best way to put it, where you're like, we don't need carry here, we don't need fees here, we do need fees here. And thinking about it really differently. What was that first iteration of Homebrew? Was it sort of like the standard venture model, or even then were you thinking about creative structures?
Yeah, we tried to think creatively.
Mm-hmm.
When we went to raise the first fund, we actually pitched no management fee and only carry.
Mm-hmm.
And LPs were like, you can't do that.
I'm not surprised to hear that you tried that.
Yeah.
Now knowing all the things you've done. Yeah.
And literally the LPs were like, no, you can't do that. You have to have fees.
And how were you planning to pay yourself, just logistically, if you did that?
We weren't going to pay ourselves.
You had enough saved to give
Yeah.
it a shot for like
Yeah.
a couple years.
Yeah.
Okay.
We were like, eventually we'll figure this out and it'll make money. And if
Mm-hmm.
not, it's okay.
Love the confidence.
Yeah. I mean, we didn't even know if we could raise the fund, right? I had prior venture experience. Hunter had none.
Yeah.
But like a lot of things in life, our timing was really fortunate. We were, at the very beginning of the second wave of seed managers. The market did not look like what it looks like today.
Mm-hmm.
And we kind of identified a strategy and a story that fit kind of what LPs recognize as white space in the market. We decided that we were going to sit at the intersection of a very concentrated portfolio strategy and a thematic focus that played on this technology as a democratizer trend, and a concentrated portfolio, which meant a relatively small number of investments where we had real ownership, would take board seats from day one, and be the investor of record for a small number of companies. And that was just a different story at that time in the market. And we also had the benefit of pitching ourselves as, the investors who have an operating background and want that seat around the table. That is the investor who has that experience and can relate to what founders are building. That story would not work today, but we were fortunate that in 2012, 2013, it was a unique story, and we were able to raise Homebrew and get going.
On Trailblazers, we spotlight founders who succeed by doing things differently, not by following the playbook, but by rewriting it. Many of those unconventional builders and the VCs backing them run on Brex because it helps them scale with speed and focus. From smart corporate cards and high-yield banking to AI-powered expense management, Brex gives startups the financial stack they need from day one so they can spend more time building and less time managing back-office operations. More than 30,000 companies, from breakout startups like Anthropic and Cursor to global leaders like DoorDash and Plaid, trust Brex to help them spend smarter and move faster. That's why we, as a venture firm and also the podcast, run on Brex too. Sign up at brex.com/trailblazerspod to get started and claim exclusive rewards. That's brex.com/TRAILBLAZERSPOD. RocketReach is the leading sales and lead intelligence solution trusted by sales, marketing, recruiting, and business development teams to grow their businesses. Whether you're looking for a developer halfway around the world, a C-level executive in New York, or a potential investor in Silicon Valley, we connect you directly. With RocketReach, you can easily access the most comprehensive, accurate compilation of emails and phone numbers on Earth. That puts you in front of the right people faster and backs you up with a database that reaches across industries, markets, and titles, using AI to continually improve the quality of your contacts. With RocketReach, you can reach anyone so you can reach higher. Many of you know I love cold outreach. It's been the root of many of my success so far, and this is the tool that I've used the whole time. Trailblazer listeners get 15% off any plan at rocketreach.co/trailblazers. That's rocketreach.co/trailblazers. When I think about your early wins, and I did some digging on you and some of our friends, a lot of folks had said to me that you were like truly one of the pioneers of fintech investing.
No.
I mean, it's kind of obvious if I read out some of the names, but you saw a lot of things in fintech in particular before everyone else. I wanted to ask you about, like, what was the sentiment about fintech when you were getting started with making some of these fun bets?
Yeah.
Chime, Gusto,
Right.
I mean, Plaid, I'd love to hear a little bit more about the sentiment. And then my second piece to that is, like, what's your advice for folks who are told that a market isn't big enough or told that it's not that exciting, but they have total conviction, like maybe you did, that fintech was going to be huge and that was a giant market? I'd love to get your advice on that.
Yeah. I mean, like so many things in technology, like everything builds on what came before. And so our kind of prepared mind for fintech came from what had come before. So one of my very first jobs ever was at Citibank in credit card operations as a summer intern, like seeing how credit card bills got processed. When I was at Google and at Twitter working on the ad platforms, we had to build the billing infrastructure. And our own PCI compliance. And at Battery, when I was investing, I invested in a number of companies that had to figure out how to do credit card processing, pre-Stripe. So all of these things had suggested to me that this notion that technology as a democratizer, as impacting industries, was going to happen in financial services, because financial services had operated in a singular way for so long, and it was inevitable with the amount of money at stake in financial services that it would need to be modernized.
It's the money business.
Yes.
A lot of money in the money business.
So Hunter and I went into starting Homebrew with kind of a prepared mind for the opportunity in fintech, and I think the second investment we ever made was in Plaid. And at the time, Plaid was effectively building a new version of Yodlee. And Yodlee was this company that had existed for a long time, had been a modest outcome. And part of the reason that people looked at Yodlee and said it was limited was because of the market size. And our view on Plaid was, yeah, if you define the market as what exists today, then it's a small market. But we always try to think about markets as whether they're defined as being large, acute, and valuable. We call it love, markets of love. And large means, is the pain being felt by a lot of people? Acute means, is it kind of a hair on fire problem or a top three pain? And valuable means, like, can you eventually extract economic rent for addressing the pain? And our view with Plaid, as an example, was that there were lots of people who wanted to unlock banking data, to do all kinds of interesting things with it. And so there was a limited market for it at that moment, but because of emerging API infrastructure, because of the trend towards people wanting to take more control over their banking data and access new types of products and services, that there would be a new ecosystem that got created around that data, and that Plaid could be the enabler of it. So it was an unpopular investment. When we started Homebrew, we said we're probably going to invest in things that look unconventional until they're obvious at the Series B or later. And Plaid is a perfect example of that. The seed was challenging for them. The A was really challenging for them. If I remember correctly, even the B was challenging. And then it became obvious.
Because the numbers showed for it?
Yes.
Or okay, yeah.
The proof was that no one questioned really the size of the market at that point.
Yeah, because you're like, you're obviously off to the races.
Right.
Yeah.
By then, customers, they had Robinhood and Chime and others as customers, and like all these emerging businesses, and starting to have more established businesses as customers too. So you could see the ecosystem developing around Plaid at that point, which was 4 years later or something.
Yeah.
So we were fortunate to meet that team when we did, because we had a prepared mind. We were fortunate in that it seemed unpopular when we had a different position on the market, and so we were able to invest. And that was true for a lot of our earliest investments. Yeah.
How do you cultivate this prepared mind? We hear that a lot in venture. I'd never heard that phrase so much until I got into venture. It's like a prepared mind. Okay, I don't know. My mind's ready. I don't know. How do you cultivate a prepared mind? Like enough knowledge about a subject that you're able to take action. You're able to really pattern match to other things you've known. Talk to me a little bit about like cultivating that prepared mind, and if there's any tips, tricks that you do to get yourself having a prepared mind on any given subject.
Yeah, I think it comes down to intellectual curiosity. It's kind of what we look for in founders as well, is like, are they truth seekers? And we try to be truth seekers in markets and technology areas. And so we've always taken the approach of, let's have a point of view around markets that we think are potentially interesting. So let's go in with a hypothesis that this could be interesting. Let's do primary and secondary work to develop a stronger point of view around, yes, this is interesting, and here's what we'd be looking for, or no, this is not interesting for X, Y, and Z reasons. And that's kind of how we've approached it for different market segments and technologies. And then importantly, like a prepared mind can get in the way sometimes. So
you know too much.
Yeah. So at the end of the day, we're founder-led. Like our assumption always is like, we're not smarter than founders who are committed to a problem. So let's hear them out and help and understand their point of view and why they think this is interesting. And we've been fortunate to listen to smart founders every once in a while and bet alongside them. And then that's helped us develop a prepared mind for things that come subsequently. So a good example of that is our investment in Cruise and autonomy led to a preparedness to invest in Shield AI, which was focused on autonomy in a different sector. And I don't know that we would have made the Shield AI investment without the Cruise investment.
Yeah, that's the beauty too of this business, that it really does all compound, you know, that like you really, even the things that don't go well, you learn so much that the next opportunity you're even more prepared.
Absolutely.
So I want to talk a little bit about where Homebrew is today, and then we'll get to Screen Door. Talk to me about the funds you raised. So you talked about this first fund that was like hard to do, but you got it done. You raised your funds for quite some time, and then you had this big article that came out in March of 22.
Yeah.
I'm leading the witness here. Tell me a little bit about that article and that decision, in addition to sort of the Homebrew trajectory up until that point.
Yeah. So we had raised 3 core funds and 2 opportunity funds between 2013 and 2018.
That's pretty quick.
Yeah. I mean, every 3 years, basically.
Yeah. But you started in 2012?
We started April 2013, closed the first
2013.
fund.
Oh, you closed it then.
Yeah.
Okay, got it. Yeah,
Yeah.
makes sense.
We started raising in January 2013.
Not bad. 3 months?
A different time. But,
Fund 1 in 3 months? That's got to be like a headline.
I don't know. $35 million, 4 LPs.
Oh, 4 is
Yeah.
nice.
So
Whoa.
pretty fortunate.
How did you find those 4? We have to discuss.
So we were fortunate that I had some relationships from my time at Battery, but more importantly, literally every GP who was a seed manager in the market at the time, Chris Sacca, Josh Felser, Mike Maples, Michael Deering, they all made warm introductions for us. Wow. We all knew them.
Took you
and
under
had
their wing.
relationships, and they were very open because they saw the same need for more managers like them in the market. And so we were very fortunate to meet LPs who had a prepared mind for the seed market and had, in most cases, previously even committed to seed managers and were looking for more exposure. So we had 4 institutional LPs in Fund 1.
But they were also willing to gobble up so much of it. I mean, nowadays you hear, no, 20%'s our max, 10%'s our max, 5%. They don't want to have that much of it.
Yeah.
So it's amazing that you got 4 to commit.
Well, if you think about it, there were so few seed managers at that time that all those institutional LPs were investing in big funds with big positions.
So they're used to that check
They
size.
were used to that check size.
Yeah.
In fact, they didn't want anything smaller.
Right, because then it becomes annoying.
Yeah,
It
and not that interesting.
messes up
to them.
portfolio construction. Yeah.
Right.
So interesting. Okay,
Yeah.
so anyways,
So
you
we
raised
invested,
$35 million.
Yeah. So
Okay.
we raised funds over the course of the next 5 or 6 years, and in 21, early 22, we had to decide whether we wanted to raise our 4th core fund, Homebrew 4, and we had seen even from basically like 2013 or 2014, what people now refer to as the barbelling of the industry. We saw that happening right away. I think what we didn't anticipate was that the barbell would look like a 10-pound weight on one side and a 100-pound weight on the other side. But
it's a true barbell. You know what I mean? It's like or seesaw.
Yeah,
where like one
exactly.
is really heavy and the
Yeah.
other's like up. Yeah.
Well, that's why the industry looks like a malformed muscle builder now.
It really does. I mean, every day you see crazier and crazier stats about it. Yeah.
In any case, so we saw that, and so Homebrew 3 had been a $90 million fund, and our view was that in the market that we were in and heading into, that a $90 million fund was a tweener, because you couldn't lead a $5 or $6 million seed round comfortably, but you didn't have the flexibility to write a $500,000 check and have an impact on the fund. And so we decided that we didn't need to get bigger or get smaller. And bigger probably meant something on the order of like 250 or 300 million. But strategically, we were of the mind that we've always believed that a pre-seed at seed, you have to aim for a 5x fund. And if you do the math around what it takes to return 5x on a $250 or $300 million fund, it means you probably need to own 15 to 20% of a company out of the gate. And that introduces a lot of constraint in terms of the type of investing you can do. And it also means that you can't collaborate with people. You have to have sharp elbows. And when we started Homebrew, we were able to collaborate with everyone. So it kind of got away from what we loved about the business. It also probably meant that we had to grow Homebrew beyond the 2 of us. And we had said from the beginning it was never going to be larger than the 2 of us. There's a team of 4 at Homebrew. It always has been, basically. 2
You
of
and
us.
Hunter, and then like two junior investor operator?
No, just
Or
a
just
head
2
of
operators?
talent and our head of operations. That's
Yeah.
it. So we didn't really, and as I mentioned, Hunter didn't ever want to manage people again.
So you were managing
Yes,
the 2.
yeah, I still managed the 2. So there was no chance of us kind of growing the organization. So all those things led us to make a strategic decision to say, like, we should get smaller. And then when we decided that we should get smaller, the goal of that was to have flexibility around how we invest. And we said, well, wouldn't the ultimate flexibility be if we didn't have LPs at all? Because once you have LPs, they don't want you to be in a box. They want you to have a strategy. And we said, we think in the market we're going into, the best strategy may be no strategy. Like just try to make money in whatever way, shape, or form.
At any stage, any
stage,
sector,
any check
any
size,
check.
any ownership, whatever is optimal for making money at that moment in time. And we really didn't feel comfortable pitching that to LPs as a fund strategy. No strategy, just trust us.
But there are some GPs who I meet with now who I met with one a couple weeks ago, and he was like, that's my strategy. I just do what I want. Yeah. Very like Josh Kushner, you know? And I'm like, respect. Yeah. Once you have enough of a track record, there are people who will write you a check.
And our LPs would have.
Yeah.
In fact, when they were ready to support us at $300 million, and many of them wanted to support us at a smaller size. For some of them, it didn't make sense for them to be able to write smaller checks into a fund.
Back to our first conversation.
We only ever had 10 LPs.
Wow.
So,
even at the 90.
Even at, yeah. Wow. We had the awkward conversation with our LPs that we're going to turn Homebrew into basically a joint family office and evergreen vehicle and not have outside money anymore. Because at the end of the day, the business model of venture capital was getting in the way of us doing the work that we loved, which was working with founders who want to work with us. Because it's not always true that when you meet somebody you want to work with and who wants to work with you, that they have 12.5% of their cap table available to sell you at a reasonable price. And so we said, let's optimize for being able to say yes as often as possible.
With whatever allocation's available.
Yep.
And just be along for the ride.
Yep.
How does that change the board seat conversation? Like, do you just do it now when you want to? Does it reflect the bigger check sizes you are writing? Or do you just say, you know what, we just collaborate and write checks whatever size and we don't ever take board seats?
Yeah, we will do whatever the founders want us to do.
Wow.
Yeah.
True flexibility.
True flexibility.
How's it going? It's been a few years. Yeah. How do you like the structure?
It's been amazing.
Yeah? You're happy?
Really happy. We're very happy we don't have a $300 million fund in this environment. Mm-hmm. We're very happy with the flexibility because it means not only do we get to collaborate with people, but people share more with us. Mm-hmm. So our deal flow is up 2.5 times because there are people who will just share everything they do with us because they know we'll just fit into the cap table in whatever way makes sense and that we will try to be helpful. So it's been really incredible and it's been really rewarding because I think founders feel like we're 100% aligned with them. It's our money. Mm-hmm. So they come to us with the same types of problems they historically would have come to us with, but they look at us now more as a consigliere than as an investor.
Yeah.
So we say we kind of bring the experience of an institutional investor with the flexibility and the demeanor of an angel investor.
And even the relationships of an institutional. I mean, I think that is so much of it too. Like, I love angel investors. They're wonderful. Or, let's talk about like big family offices. But they don't have like the depth and the history often of being like truly on cap tables with other great investors in the ecosystem. So it's like the best of all worlds.
Yeah. So it's been awesome for us. And of course, it's been a great time to be investing if you can get into special companies. And so we feel really lucky.
That's amazing.
Yeah.
Well, I'm so happy for you. And I'm glad you still like it. I think that's so much of this business is you can make money in a lot of different ways.
Exactly right.
Finding the way that aligns with what you want and who you are. Yeah. And to what Hunter said, don't manage people. Yeah. Just stick with that.
It's always been our North Star as we started this because we wanted to spend our days a certain way.
Yeah.
And we figured out that if we are able to spend our days the way we want, that we'll probably do decent work and then the economics will work out.
Yeah.
It's kind of what I tell people in their careers, too. Like, there's lots of things you can optimize for, but just optimize for people and problem. Like, people you really want to work with, you're going to learn from, they're going to give you rope to hang yourself with, and a problem that you care about or something you think should exist in the world. If you have those two things, then it frees your mind to do your best work. And if you're able to do your best work, everything else figures itself out. I think people optimize for the wrong things in their careers lots of times.
Yeah. Well, I also think it's important to, tell that to early career folks. I think in hindsight, you're like, yeah, of course you got to optimize for that. But when you're in it, you're like, there's so much to do. I'm so behind. And so it's good to hear that advice from someone who's like been through it for a bit. Yeah. I want to talk a little bit around that time you made this homebrew decision. You decided to start Screen Door. And I'd love for you to tell everyone, what is Screen Door? Why did you want to start it? And how's it going?
Yeah. So Screen Door is effectively a fund of funds that invests in early managers, usually Fund 1 and Fund 2, to help them build their businesses. We try to be an anchor check, so at least 10% of the fund, and we try to surround those managers with experienced managers who have built their own funds. And I'll get into why that's the case. But we really started it because starting in probably like 2015, 2016, there wasn't a week that went by where Hunter and I weren't approached by somebody who was looking to raise a venture fund. And there were a few things that struck us about those conversations. One is that the vast majority of those people were not coming from other venture funds. They were coming from operating backgrounds. They were coming from academia. They were coming from kind of places where they hadn't had the chance to apprentice in the business. But a lot of those folks we thought had something really interesting to offer the ecosystem. But the second thing that came through in those conversations was, to a T, all of them said, there's plenty of advice for us, but there's no capital. Institutional LPs keep telling us, like, come back for fund 3 or 4. Your funds are too small. You don't have track records for us to evaluate. Like, the math didn't math for them. And we kept hearing this over and over and over again. And then at the same time, we had seen this barbelling of the industry that we referred to. And having worked with a lot of companies at that point and worked with a lot of investors, our view was that there are a lot of investors who were getting fat on fees and not working hard for founders anymore. So we thought that new competition in the industry would be healthy for the industry and good for founders.
And good diversification for these institutional LPs. I mean,
we'll
that's
talk
a big
about
part
the
of it.
LP value proposition.
Yeah.
But it was really first like a GP in a market problem or white space that we identified. We come from product backgrounds, so we're always looking for product opportunity.
And then the diversity piece too is something you didn't mention that yet, but that is a very big part of it. What made you want to choose that versus just any emerging fund manager?
We had this view, as I mentioned, kind of in passing, that everything in technology is built on what came before, and we're all standing on the shoulders of giants. Hunter and I have been fortunate. We don't come from the Valley. Hunter's from New York. I'm from Las Vegas. So there are people who kind of reach down the ladder and pull us up along the way. And we're very fortunate in that regard. And we wanted to kind of recreate that dynamic because so much of the Valley is about like the networks you have. And there are so many people who are incredibly talented, incredibly insightful, who aren't part of their networks through no fault of their own. And so we wanted to kind of create a way for them to on-ramp into this kind of network of people, this community that benefits from this virtuous cycle in technology that exists, right? Like investors back founders, founders hire people, companies go on to be successful. Those people then start investing capital back into the ecosystem, started investing talent and advice back into the ecosystem. But you have to insert yourself into that virtuous cycle somehow. And for us, at that point in our careers, we weren't going to grow homebrew. So we thought the best way of kind of helping people get inserted into that virtuous cycle was the LP entry point with us as LPs, because we could then back founders, back venture capitalists who would in turn back founders who would then hire employees and kind of start that virtuous cycle for people who maybe historically hadn't been part of it. So we had kind of, I guess, a societal mission in mind, but also kind of an economic point of view around opportunity in the ecosystem to introduce new competition. So that's a long-winded way of saying we started Screen Door in the summer of 21, and our value proposition to GPs was anchor capital plus advice from GPs who have built their own firms, to kind of a virtual apprenticeship because most of these people hadn't worked at Sequoia and Excel and wherever else. And then for LPs, we had been hearing from LPs for a long time that they can't deal with all these seed managers coming to market because now this is 2019, 2020, 2021. But they know increasingly that that's where venture alpha resides, right? As the big funds were getting bigger, they're selling a very different product and a very different return profile. And if you wanted 5x returns, then you really had to be at the early stages of the market. And given how much noise there was, they couldn't make heads or tails of it. Their institutions couldn't write checks that small. Their teams are small. They couldn't spend time meeting with all these managers. So they needed a product that acted as an extension of their team and helped them make sense of that market. And historically, fund of funds had operated kind of like a black box, right? LPs would just give them capital and they'd return it at some point. And our kind of product with Screen Door was to talk to LPs and say, hey, we're going to be completely transparent about everything that we do because we want you to build direct relationships with these managers over time.
And then maybe they can come in for their Fund 5,
Yes,
Fund 6, and
exactly
kind of
right.
circumvent you guys.
Yeah, maybe even come in their Fund 2 or Fund 3 because they already have an understanding of these managers and the work that they're doing via Screen Door.
Yeah, and they trust your conviction too, hopefully. That's part of it.
Yeah, and our view was Screen Door being, at that time, myself and Hunter and 8 other GPs that we kind of recruited had a unique ability to evaluate managers because we are managers in the market every day. So that
As opposed to like the junior person that like the Ford Foundation hires
Yes,
or whatever that's
exactly.
like lovely but maybe isn't in it,
Right.
the weeds. Yeah.
Right. So that was the LP value proposition. And so we raised our initial fund, which is about a $90 million fund in summer of 21 and launched it. And then we knew from day one that it couldn't be a full-time job for me and Hunter, but it deserved a full-time team. And so we started recruiting a full-time team, and there's a full-time team of 3 now, and they're on their second funds. And it's been incredibly rewarding work because GPs who are starting funds are just founders of a different kind. And so we get to work with, startup founders partially and VC founders a bit as well.
Yeah, that's what I tell people. I'm like, a lot of emerging managers look like a VC on the outside, but they're like 95% founder.
Yeah.
And they're in your shoes too. They're raising, they're figuring out their value prop, all of that. That's awesome. And I'm glad to hear that it's going really well.
Yeah.
If you work in venture or startups, you know the constant juggling act. Replying to messages from co-investors, founders, LPs, customers, and teammates all hitting your personal number. I know this very well. We all hand out our cell, which means your EA can't help an iMessage, and important threads get buried. That's why I'm very excited about Quo, formerly OpenPhone. It's built for founders and investors like us who want communication that feels personal but stays organized. Quo gives you a dedicated business line on your existing cell phone. And if you already have a business number, you can bring it with you for free. Plus, you'll get call summaries, transcripts, and an AI voice agent called Sona that can answer and schedule when you're offline. We're actually cooking up something fun with the Quo team right now and using that same voice AI tech in a new way for our firm. More soon, but it's a great reminder that you can use voice AI to stay top of mind of your customers' needs. Quo is trusted by over 90,000 businesses and rated number 1 on G2 for customer satisfaction. You can get 20% off your first 3 months at quo.com/trailblazers. That's quo.com/trailblazers. So I've actually used Gusto at 3 different companies, and every time it's been such a relief. It's simple, it's reliable, and my paycheck was always on time, no drama. And unlike the big clunky payroll systems out there, Gusto is online payroll and benefit software specifically built for small businesses. It's all-in-one, remote-friendly, and incredibly easy to use, so you can pay, hire, onboard, and support your team from anywhere. For smaller startups in particular, I have found that it's the most affordable and easy to set up option, and it's the one that we recommend to all of our startups at our firm. Try Gusto today at gusto.com/trailblazers and get 3 months free when you run your first payroll. That's 3 months of free payroll at gusto.com/trailblazers. One more time, gusto.com/trailblazers. Amazing. Well, I could keep asking you questions, but I want to be mindful of your time, so I'm going to get to our lightning round.
Okay.
Okay. Tell me the first thing that comes to mind.
Mm-hmm.
Okay. Book in hand or podcast in ears?
A book in hand.
Any favorites as of late?
As of late, I just read for the first time Battle Cry for Freedom, which is maybe the best book ever written about the Civil War.
Yeah.
Team of Rivals is up there too, but Battle Cry for Freedom is incredible if you care about that time in American history and the dynamics around how the war started and how it was resolved. And there's just so much depth in that book around every aspect of the country at that time. And so much of it mirrors some of the things we're going through now.
I was going to say.
It's really powerful.
Yeah, we're going through a little civil war of our own here.
Yeah.
A digital civil war, if you will. And yeah, I actually think there was actually a really interesting talk. It was either at like Milken or Upfront.
Mm-hmm.
You might have even been there. I can't remember which one, where there was a like economist/historian who was talking about the different traits that make a country more or less likely to go to a civil war.
Yeah.
Do you know which talk I'm talking about?
That was Upfront.
That was Upfront, maybe? Yeah. Such a mind-blowing talk.
Right.
About how like America is either like trending towards or trending away from civil war, and like what does that mean?
Yeah.
Anyway, hopefully we'll try to link that because that was a good talk.
Yeah.
Morning person or night owl?
Night owl. I mean, Hunter and I joke that we're the perfect partners because he is a morning person and I'm a night owl. So if we go to the same conference, we've got And most days we have 20 hours of 24 hours covered.
You can also tell founders, like, we will respond to you within the hour
Yeah.
because either I'm responding or he's
Exactly.
responding.
We have high SLA.
Yeah, I love it. Exactly. High SLA. Cooking dinner or ordering in?
Cooking dinner.
Okay. What's your favorite to cook?
What's my favorite to cook? My family would say that their favorite thing I make is carnitas.
Ooh, fine. Did you have like a secret that you add in there that makes it so good, or you've just perfected it over
I think
time?
I've just perfected over time. We cook in a lot and eat a lot, so we're as a family we're into food.
I love that.
Yeah.
I love that. It's always so fun hearing what people love to make.
Yeah.
VC or bootstrapping? You're a fun person to ask this to.
Oh. As a founder, I think bootstrapping because I like controlling my own destiny. Though I know people argue like you need VC to have scale ambitions, but I think that's because their understanding of VC is not what VC is anymore.
Mm-hmm.
I think VC is all about taking risk at the earliest stages, and I think investing at the later stages right now is capital allocation.
Mm-hmm.
So I think you can bootstrap your way to a scale where then you can take capital at later stages. And not take as much dilution and have more control of your company. Of course, my business is VC, so I'm always going to be supportive of people who want to take VC, but I think fewer and fewer businesses probably should take VC.
Yeah, we also don't have LPs that'll scream at you for giving the right answer. It's
I
the
don't know if
beauty.
it's the right answer. It's our point of view.
Yeah, well, whatever answer feels authentic to you.
Yeah,
You know,
right.
you won't have anyone yelling at you for it.
Yeah.
It's interesting. There's kind of two different camps. There's like the camp that you just described,
Mm-hmm.
where you bootstrap it to the point where you can just like throw money on it and just scale really fast at the growth stages, or you like raise a bit of early stage capital, find those aligned partners, maybe get a price round underway,
Mm-hmm.
hire top talent, pay for like a lot of the early risks, and then control your destiny and grow quickly.
Yeah.
What's your take on what's going to be more popular? Because again, you have like hotshot VCs pushing
Mm-hmm.
one and the other. What do you think?
I think the market is going to drive people to choose the latter path.
Mm-hmm.
Right? Take capital, push hard, raise more capital when you hit certain milestones, or maybe even when you don't. But capital is abundantly available, and if you have the right team and an interesting market and early signs of momentum, there's more and more capital available to you.
Yeah.
And I think most founders can't resist the siren call of capital and VCs.
I mean, there's an ego piece to it all. You know?
I think, for so much of the last decade, people have kept score based on valuations and raising capital. We've never kept score for Homebrew with assets under management. We look at, cash on cash returns, and those have been good, fortunately. And I think founders should be thinking about it the same way as like, we can raise capital, but what's the return on that capital? And if they thought about it that way, and in particular what it means for their own ownership in companies, I think they might think about venture capital differently. But most people don't do the math when they're
It's not comfortable to do the math, It's easier to just sort of take it, ingest it, and go. I actually think my hypothesis here is that a lot of it has to do with the media.
Mm-hmm.
The media glorifies as raises and not revenue generated.
Mm-hmm.
They glorify like giant teams versus like revenue per employee. Like
Right.
there's just some metrics that I think, unfortunately, like our industry puts on like higher pedestal when it should be on the lower pedestal.
Yeah.
So I'm hopeful that we can. I mean, media reform is its own beast, but I think a lot of it is kind of who the talking heads we look to and what they praise.
Yeah, but I wouldn't blame just the media.
Yeah.
I think our industry has done that too.
Yeah.
Because the best known firms in our business have raised incredible amounts of capital and put that to work in big slugs. So when those are the people that people look up to in your industry, they're going to try to mimic that behavior,
Totally.
right? Or be part of that ecosystem.
Totally. I'm sure you saw this too, but there was some crazy stat that like, all of the profits from all these giant firms have come from like 3 companies. Did you see that this
Yeah.
past week?
Yeah.
Wild. Okay. Networking dinner or big conference?
Networking dinner.
Yeah.
Yeah, I'm an
Tell me more.
introvert, so big conferences kill me.
Okay.
Yeah.
Fair. Hire slow or fire fast?
Hire slow.
Okay. Tell me more.
I'm a big believer that company culture is defined by the first 20 employees at the company. And I'm also a big believer that culture is really hard to change. So hire slow is all about hiring people who, of course, have the right aptitude, but more importantly, have the right attitude for your organization. And that's not to say like there's one right type of culture, but what's right for your organization and making sure people line up is super important. And I think that's hard to evaluate quickly. Like you need to spend time with people, you need to do references with people, maybe even have them do trial work or projects. But I'm a big believer that hiring slow, while painful in the short term, pays off in spades in the long term. Like we tell people all the time, sometimes you have to go slow to go fast. And I think most people ignore that advice, but it's something that we come back to over and over and over again.
Yeah.
The companies that fast to go fast, like don't end well.
No. Yeah, it's funny you're saying that. I'm like seeing it with one company right now, and it's just like, oh, I'm just feeling it. Yeah, it's really rough. And I think your point about figuring out culture is important both for the founder and the operator, because like the operator deserves to be in a spot where they're treated fairly. I just want to ask you one quick question on this, and then we'll get back to the lightning round. You said at Homebrew you look a lot for this, like founders who will build great culture. Are there any questions you ask or things that you look for beyond just traditional reference checks? Like, as an example, diligencing a founder right now, spoke to 2 people that they managed and 2 people that managed them. And I'm getting like my read on that.
Yeah.
But what more do you ask? What more do you use as like a tell to decide if they're going to build a good culture?
We will ask them things pretty explicitly, like what are the characteristics of the people you want to hire?
That's a good one.
When have you established company values, or what process do you think you'll use to establish company values? And we don't look at values as like things on a wall. Like we look at values as things that help the business and people within the business make decisions about what to focus on or what to say yes to. So answers to these questions, have real business impact.
Yeah.
So we'll be pretty direct on those types of things. And references are super important, but more important is how are they thinking about these things in the context of building their company.
Yeah, and like you said, like there's no one right answer. It's just understanding their rationale, it sounds like.
Yeah, it's just important that they've thought about it.
Yeah. No, they're already at Series A and they're like, values? That's for later.
Right.
Cool. Okay. 10 small wins or 1 big moonshot?
1 big moonshot in our business.
That's our business.
Yeah.
Okay.
I would say in company building, probably 10 small wins, because 10 small wins compound into 1 big moonshot. We don't have that benefit in our business, which is a power law business.
Yeah, sadly, we just need 1 big moonshot,
Yes,
and the rest can
exactly.
go to 0.
Yeah.
Being early or being right?
What's the value of being early if you're wrong? Be right.
Okay. Right's all that matters.
Right's all that matters.
Okay.
Well, I mean, ideal is early and right.
That's true.
But people who invested in Anthropic at $200 billion look just as right as people who invested early. Be right.
Yeah, I hear you. Never post on socials again or never fundraise another dollar again. You're kind of a funny person to ask this to.
And no socials. I'm basically not on socials as it is.
But you are not fundraising also for the fund.
Yeah.
So I guess you're kind of stepping out of both fundraising and socials.
Yeah, right.
So your answer, though, is no socials.
No socials.
Really?
Yeah.
You haven't written in a bit.
Right.
I was looking at your blog just to sort of get up to speed on like recent stuff.
Yeah.
What's the rationale there?
I feel like for me, there was a point where what I had to say was additive to the ecosystem. And now there's so many people writing so many things that I don't feel like it's meaningful to me or to a potential audience. I'd rather have those conversations one-on-one and it be very specific about feedback I'm giving or points of view. There's no joy in it anymore. And so we've always opted to do things that are authentic to us. Like we were never on socials because that was the thing to do as an investor. We were, I worked at Twitter and Hunter worked at YouTube. We were always on socials. I was blogging even when I was back at Battery. So we just decided that it wasn't impactful for us personally anymore.
Great.
Yeah.
I also think, if you have something to say, people will listen more if you do post after 4 years or 5 years, right? Like there's something to be said too for like really only sharing. Like I'm a big fan of having a newsletter that has no particular cadence. Like that's my vibe.
Yeah.
Like people that do weekly, I'm like, I don't even know how you could come up with stuff weekly. Just post when you have something to say. Share when you have something to say.
Yeah, I think there's probably some truth to that. I think we're old, and so we believe we live in a world where it's the loudest voices that get the most influence and audience, and we've never been the loudest voices. We don't care to be.
Yeah.
So we'd rather have people seek us out who want our point of view and insights, rather than kind of expound them and try to convince people that we're right.
Totally. Or like you said, the one-on-one relationships where like you can connect the
Yeah,
dots.
it matters way more to us.
Yeah, totally. Okay, last question. Ready?
Yes.
It's the big one.
All
Going
right.
right for the jugular. Ready? Is AI overhyped or underhyped?
Yes. Like all things in technology, I think the impact in the short term is probably overhyped, and in the long term, probably underhyped from a pure technology standpoint. I think the thing that doesn't get enough conversation, which people are starting to talk about, is the actual real world impact of AI and the dislocation that's going to happen because of its impact on skills in the workforce and economies. So as an investor, it certainly seems overhyped in a lot of areas right now. As a citizen of the world, it seems underhyped relative to the impact that it's going to have, even in the short term.
Yeah. I appreciate a nuanced answer. That was good. And I agree with you.
Yeah.
That was awesome. Satya, thank you for being here.
Thanks
This was
for
so
having
much
me.
fun.
So fun.
Yeah, I loved it. Thank you.
Yeah.
On Trailblazers, we're always talking about multiplying your impact, and that's exactly what Athena helps you do. Athena pairs you with a world-class executive assistant who becomes a true force multiplier for your business and your life. Working with my Athena assistant has been transformative. Gab was instrumental in raising Park Rangers Capital's fund in ways that I could have never imagined an assistant could contribute. From closing six-figure checks to identifying new LPs we should meet to matching my tone perfectly in follow-up emails. He's elevated my capacity as a founder by giving me more time to focus on the highest leverage work. Athena isn't just about scheduling meetings, it's about unlocking leverage. Hundreds of founders, investors, and executives trust Athena to free their time and scale their impact. Athena is offering our listeners $2,000 off for their first year of service and priority onboarding. And you want that, trust me, there's a very long wait list. When you're ready to multiply your impact and free up time for the things only you can do, go to athenago.me/Erica-Wenger. That's athenago.me/ERICA-WENGER. Thanks so much for listening to the Trailblazers podcast. If you enjoyed this conversation, be sure to follow the show so you never miss an episode. You can also support our work by sharing it with a friend or leaving a quick review. It helps more contrarian builders find us. For more on Park Rangers Capital and our community of elephant founders, head to parkrangerscap.com or find me online at Erica_Wenger. Until next time, keep trailblazing.